A business that they've created from scratch is like a family member to them. They're deeply emotionally involved in the business. The biggest key blind spot is not communicating. There is a level of herd behaviour. There is a risk there that you may be going into safer haven asset classes at the time that they are at their peak. It's safe to say that we are seeing structural volatility emerge in the markets. Historically, we've had a fairly stable environment with globalisation. We've had policies that were fairly predictable. We had abundant labour across global workforces, and a lot of those foundations have been eroded over the last few years. So globalisation, moving away from efficiencies through supply chains to more resilience in supply chains. Probably most critically at the moment is the geopolitical environment and the unpredictability of policy frameworks that exist across the globe. So that in itself is creating a lot of volatility in the markets, uncertainty for investors. But there are also other things that are coming through around energy transition, AI, technology. The world is a far more complex place than what we've seen in the past. So that'll create opportunities, but it'll also create deflationary pressures in some aspects, inflationary pressures in others, and investors are looking for where these opportunities may exist and also trying to preserve wealth in a way that's a bit more effective for them. The traditional days of an investment portfolio being 60-40 split between equities and bonds has shifted dramatically over the last decade. Uncorrelated asset classes as well that are available through alternatives, including infrastructure, private credit, private equity, where there's not mark-to-market implications necessarily as close to the listed markets. As well as other asset classes that may exist. The reality is diversification is still critical in investment thinking, not only from asset classes but geographically as well. This is an opportunity to take advantage of different types of regimes across the globe, different opportunities that exist. So they are thinking more broadly around the diversification of their portfolios. The challenge in a lot of cases is the creep that emerges, right? So overexposure to certain asset classes that may have crept up over time through passive strategies where they've just let the portfolio go, taking a more active approach in how they rebalance the portfolio, understand what is coming in terms of potential challenges and disruptions, and making sure that that long-term strategy is preserved and that we're not seeing a position where they're rushing to make changes rashly to their portfolio where they actually may cause disruption for their portfolio longevity. Looking at the overall makeup of the portfolio and ensuring that there is an adequate level of diversification. There's been a move towards technology, certainly for a number of years now because of the obvious opportunities that are seen to be there from a productivity standpoint. Certainly there's been a lot of wealth that's been created through that. Emerging asset classes, this still makes a very small proportion of the portfolio, but again, it really comes down to the legacy statement that a lot of these families are coming up with from a portfolio perspective to determine where they would like to go. In Australia in particular, there is a lot of wealth tied up in entrepreneurship. So there is a lot of money, wealth that is tied up in the businesses that a lot of founders have created. That presents a bit of a challenge for them because they've got clearly less diversification. But as we think about next generation succession within those businesses, that presents the opportunity to be thinking about how they can diversify a portfolio in a more meaningful way. So talking about those families, certainly the ones that are founders of a business, there's multiple challenges in this. A business that they've created from scratch is like a family member to them. They're deeply emotionally involved in the business. They understand it back to front, and often whether it be succession through family to take over a business or selling the business, liquidity events, creating governance structures where a board may be established so that others run the business. There's often an emotional disconnect in terms of the direction of the business and the passion that exists in those founders to whether it be the next generation or others running those businesses. So there's always a bit of tension there. And what we're finding, certainly in Australia, is those founders stay in the business for a lot longer and they don't relinquish control. And inevitably there will need to be a transition of some sort. So there's those challenges. When it comes to investment, it's often family unity as the driving factor around how they design, set governance frameworks and invest. They would like the family to continue to have the wealth, preserve the wealth, and ensure that there's unity within the family. The biggest key blind spot is not communicating. not having any strategy in place, not thinking about what needs to happen for the next generation. And often things fall over when that communication hasn't occurred and they haven't set the appropriate governance structures in place for the next generation of wealth. We see it often where there's a passing of a family member, there's a very complex structure of asset classes that are sitting across multiple entities, multiple structures, not designed in a way that's effective. Another one is just lack of diversification. So whether it be a founder, where most of their wealth is sitting in a illiquid asset being a business itself, organic portfolio that's been grown over time without much advice or structuring thought, over-indexing into certain asset classes which could be highly volatile. We're seeing newer generations going into these newer asset classes that are very volatile, have seen a lot of people make a lot of wealth, but also potentially lose a lot of wealth as well. Cryptocurrencies is one, and potentially if you overexpose yourselves to these types of asset classes, the risk is higher and therefore there could be significant levels of volatility. The other one is around the drift of a portfolio, right? Setting a portfolio up and letting it go for a period of time without regular reviews may mean that you end up becoming over-indexed into certain asset classes because of the growth trajectory. So having regular reviews to that portfolio and the makeup of that portfolio and making sure there's sufficient diversification in that portfolio is also a critical element which is often a blind spot. While geographic diversification is still critical, it's evolving. Historically, the way that you would look at geographic diversification would be to buy listed assets or non-listed assets across the globe. What we're starting to see is because of the globalization is a lot of these deemed uncorrelated assets are becoming more correlated, particularly when you are seeing significant global events occurring. I will acknowledge when markets are volatile, the phones do certainly run hot because people are concerned about the ongoing longevity of their portfolio and the performance of their portfolio. We see panic selling. We also see clients take an opportunity to look at values of assets that may be undervalued due to shifts in volatility in the market and look at that as an opportunity to go into things and tweak their portfolios. There is a level of herd behavior in crisis. There is a risk there that you may be going into safer haven asset classes at the time that they are at their peak. We see a rush to cash in some cases as well. What long-term markets have showed us is that staying in the market and investing wisely through the cycle tends to perform better than parking money in cash and then coming back into a market when things have recovered and already on the way up. Infrastructure, for example, is a big one where you get income as well as a correlation to inflation. Private credit has certainly been a significant growth area for a number of years, where they're not necessarily seeing mark-to-market implications there for those clients. They're getting yields in rising interest rate environments if floating portfolios exist, but there is also growth and yield within that. There's also the opportunity to look at hedge funds. Hedge funds tend to manage things, as long as they're managing things well through volatility, tend to do quite well because they can take long, short positions and look at the opportunities that are existing through volatile markets. And there's also the property element as part of the real asset component, which is another asset class. Long-term strategy prevails, making sure that the long-term strategy that's been defined and communicated and agreed to as a family sits ahead of any short-term volatility that may exist. That doesn't mean that they don't take advantage of the short-term volatility, but making sure that the portfolio is balanced in a way that the intentions of the family are well known and understood so that they can make the appropriate tweaks throughout the portfolio and agreed to well in advance of market shocks. The family dynamics are the most complex element of multi-generation families and wealth and succession intergenerational wealth. It is the changing behaviours and values, and as families get larger and larger through spousal, children, etc., views change, the appetite for that risk may change, and in some cases there may be a need at some point to split the wealth. Split the wealth into different buckets, and a family that was a single family office may become multiple family offices as those families get larger and larger. From a bank perspective within our business, we actually have a family advisory team. Their role is to cultivate this conversation or bring it to the surface with families, multi-generation families, to create the lines of communication at the right time, which is early, not too late. And then set governance frameworks in place through legacy statements and the appropriate governance and structuring so that for multiples of generations, there is preservation of the wealth and growth, with the ability to tweak the portfolio through this open communication framework that exists.